Okay, so this workshop is presented by Regional Arts WA, and it's part of the Regional Arts Sector Investment Program. So it's been delivered today by myself, Annette Carmichael, and Julian Canny from Euphorium. And I really want to thank the supporters of the investment fund, which is the Regional Arts and Cultural Investment Program with support of the Department of Local Government, Sport and Cultural Industries, with royalties for regions funding through the Department of Primary Industries and Regional Development. So that's how we are here today. So financial sustainability is a key criteria for people applying to the Regional Arts Sector Investment Program. And this workshop is just to provide some additional tools that can help you in your planning for your application. But that's really just a small part. The main bit is that we want to support and provide skills to organisations so that moving forward for the regional arts sector, they are able to become more sustainable, and we want to make great art. And for those of you that have had a chance to read the Artistic Vibrancy ebook from the Australia Council, you'll get this language. We're all about making great art and art that has impact. To do this, we need thriving organisations. We don't just need organisations that are going, like some of you have said, from one project grant to the next, just hanging on by the skin of our teeth. We don't want that. We want to have organisations that are confident, that can move forward into an exciting future. And today's workshop is the first time Julian and I have presented this, and we're all learning about how we can do this and how we can influence Regional Arts WA, other policymakers, but also how we can support each other to create a future that has so much more happening in it and is much more enjoyable for all of us because we're thriving. So an artistically vibrant organisation in our context is able to support regional artists. It's able to respond to its communities, and it's able to take risks. So one of the criteria of the fund, if you are applying for the top level, up over 45,000 up to 60,000, is that you need to demonstrate that you have a cash reserve. And a cash reserve is just that. It's a bunch of cash that you can use for any purpose that supports your organisation's goals within the constraints of your constitution or the legal instrument that's managing your organisation. It's not a grant that's being held for a specific purpose. It's not funds that are being held to pay obligations like PAYG tax or superannuation. It is cash that's just freely there. It's a dream. And so if you're applying for the top higher levels in this fund, you need to show that you have 20% of your annual turnover held as cash reserve. And when I say turnover, in this instance, we're looking at your total operational income. So how much money do you need to run your organisation and deliver your programs year to year? Ideally, 20% is recommended that is held as a cash reserve. Where it shows up is it lives on your balance sheet. So it can be built over a number of years. And for some organisations, especially at this time with COVID-19, 20% is just not possible. And so we're saying, have a goal, start building it. It might take you 3 years or 5 years. And part of this workshop is showing different ways that you can generate more income and put that into your cash reserve. Cash reserves are looked after in different ways by organisations. Some choose to have a separate investment account, and that's where they put that cash and they can see it, it lives as a separate item on their balance sheet. Other people have cash reserves and they are invested in other investment opportunities. It might be term deposits, but it also can be in other cash or liquid investments. Some people hold all of their cash in one operational bank account. If that is the case, then you need to devise some other way of knowing which bit of that cash is free and able to be used year to year. And that might be via just a simple spreadsheet. Now, I mean, I have been an arts manager for a really long time now, and like many of you that are really experienced in this workshop today, we got into the habit of expecting that we weren't allowed to have a lot of cash reserve, that we had to spend every beautiful dollar that we got given for the purpose it was given for. And we want to change that conversation, particularly with local government, and Regional Arts WA are really heading out in front with this and saying that if we're going to survive things like COVID-19 or surprises that come our way, we need to be able to take some funds every year and put them over into a cash reserve. But you have to be able to frame up an argument to your local government, even to your board. Sometimes boards don't want to do it. And so this is some information that's come from the WACOS, from an organisation that supports organisations that are working in communities. And they say that, having a cash reserve provides you with cash flow that means that you can actually do what your organisation needs to do. So cash flow's there when grant payments come in late, or maybe you need to shell out money to earn money. For instance, if you are putting on a performance and you need to pay upfront costs and then the ticket money comes in later. So a cash reserve supports the cash flowing through your organisation. It's not just there for emergencies, it's there so you can seize opportunities when they arise. You can be more responsive to a chance for to work with an incredible artist, or a chance for your organisation to be incredibly responsive to a problem faced by your community because you have cash and you can activate quickly. I love this next point in that having a cash reserve reduces staff turnover because it reduces stress. And I know this personally. I have been in the management of an arts organisation that was incredibly cash poor, and just how that consumed my time day to day, and the stress that flowed through the organisation because we just couldn't have enough cash. And that meant that good people stopped wanting to work for us because of that stress. And that was such a loss. And that had an impact on our ability to make great art. Having a cash reserve gives confidence in your organisation. People want to invest in success. They just do. And so when you as a person working for the organisation has confidence that you've got some money in the bank that backs you up, it really shows in how you talk. And simply that balance sheet that's nice and healthy means that it's more likely that other people are going to take risks with you, are going to give you funding, jump on board in a project. Cash reserves do help you attract better board members. Those good board members, those ones that ask to see your balance sheet before they agree to sit on your board, they are doing that because they want to check their own risk. They also want to check the level of enjoyment they're going to have in the board appointment. Are they going to come on board to a successful organisation, or are they stepping into an incredibly stressful one? So cash reserves help you get better skills, better people. And I said this before, it promotes donor confidence. Money does attract more money, and people want to give money to organisations that are going to be around for a long time, and cash reserves show that. How do we do that though? All well and good, Annette, but how do we do that? And so this is where I'm going to hand over to Julian, who has put together this beautiful workshop from all of the learning that he's done over the years, but also the failure that he's experienced as well, Julian. And I think that sharing, we learn from doing and getting it wrong. And so this is, I'm going to hand over to him to describe some tools and some ways of thinking about your revenue streams. Okay.
Great, thanks for that. Can you just set me as a host so I can share my screen? Yeah, great. So today we're gonna talk about a couple of things. In my examples, I'm gonna talk about our experience in particular, just as been something that we have obviously lived. So with Euphorium, we're on our third we're about to move because of COVID into our fourth iteration of Euphorium, or whatever it was, the Comedy Emporium before that. So that we've had two collapses of that business model that we had collapsing over the past 8 years, then rebuilding from that. And now this third one is, luckily, it's not our fault. It's amazing how much less stressful your business model not working when a pandemic hits, when it's not actually your fault. So it's been really fun to actually be able to work on the next kind of iteration. So but from that as well, we've had a lot of great success. So when I say those failures basically built where we are today, which is, so at the moment we're a small but a very nimble team. So we were on track to do about 270,000 in turnover, and most of that was not necessarily grant funding, but because of COVID, we lost a lot of work, but that's okay. We still did pretty well this year to be able to keep our staff and everything. So, all right. So in order to increase your revenue, you need to understand it. So this is basically going to be the cornerstone of the things we talk about today. I could sit here and give you a list of all the different ideas that you could go out there and run a cake store and do training or whatever it is, all these different ideas of products you could sell to make different money or different revenue or whatnot. But that's not really going to help, because as we've already known, already understood going around the group, is every single organization in this group is extremely different and has extremely different opportunities and circumstances that affect it. So what the best thing we can do, and I still stand by this from a revenue planning point of view, is to understand how your current revenue works. And once you can understand it, you can then start to see the opportunities and the gaps that you're missing, and then either exploit them or increase the opportunities that you have in front of you. And so basically, I just wanted to kind of say, so I'm going to keep it, it's going to be a little bit general and generic, but I just want it that every single person's going to have a different set of circumstances at play here. So as a result, a lot of this content is going to be really simplified and boiled down to like base elements. So you might, especially if you've got a bit more experience in business or finance or anything of that nature, you might sit there and go like, actually, there's a bit more to it than that. I've tried to keep that deliberately, so we're just kind of understanding the basic kind of building blocks of how it works. If you want to extend it and go further, like by all means, absolutely do that. But I think it's really important just to kind of come back to just some simple concepts of how your revenue might work, and then you can complicate it or add the special circumstance thing for you, or this is my special rule. Is everyone okay with that? Beautiful. All right, so we're just going to quickly cover. Depending on how we go for time, we're going to quickly cover just social enterprise revenue in general, just really quickly. Accounting and reporting mindsets, which I'll explain in a minute. We're going to talk about B2C, business to customer and business to business revenue types. We're going to talk about revenue type in general. And we're also, we want to then try and apply some of that to what we've learned and gone through to your P&L that you've hopefully brought with you. If not, you've got to apply those lessons. And then I've got a bit of a worksheet that I want to just show you that you could use or take the lessons from to use as a planning tool that you can hopefully help go away from this session. The last thing I just wanted to quickly add was this is the first time I've gone through these documents. And I'm dyslexic, and there is definitely already about 3 or 4 mistakes I've seen in the spreadsheet. So when you come across them, just unless they're really funny, I will definitely find them, and there'll be probably a second version of documents going up after today. All right, so the tricky thing that I find was the conversation, especially when I first started coming to arts 10 years ago, was around the idea that, well, you can't quantify, you can't put dollar value on the importance of art. And I kind of agree. However, you can try and sustainably manage your impact that you can create through your art that you're making. So if you have this is one of the best sayings I've actually kind of used to coin the approach that we have in particular, and that is we're a profit for purpose organization. We aim to make profit where we can, and that profit is always reinvested into our purpose and what we are actually trying to achieve. And a lot of the time, our profit will actually come from focusing on our purpose. So rather than just having an initiative to go and make this amount of money, we often will do initiatives to really refine and work towards achieving our purpose and establishing the outcomes that we're wanting to achieve. And generally, money just appears. I know that's very simplified kind of perspective, but if you have a really clear understanding of your purpose and your outcomes you're trying to achieve and the impact you're trying to make, it makes money appearing a whole lot easier. So just don't get too bogged down into the numbers. If the most important thing you can do is just really have a succinct purpose for your organization, that will then help make, they go hand in hand basically. I just threw this picture in here because it's one of our youth programs because there was too many white slides with text. So just the last thing, so just on social enterprise. So if you're not familiar with social enterprise, it's really worth having a look up. It's a bit of a movement. It's very large in Europe in particular, and that's basically the idea that there's a bit of a scale of organizations, the very generic term, from all the way from traditional charities to traditional corporate businesses that generally will focus on, they all have money, they all have the same kind of reporting mechanisms as what you have to have on your balance sheet. It's very similar to what a business does, but you have different social objectives. So if you want to have a look and research more around this area, I really strongly, the phrasing is social enterprise. And you will tend to find a lot more information around where you might fit as an organization and some suggestions on potential social enterprise business models that you can follow.
What's great about that, Julian, is that it's around social impact, which is, we're talking all about impact over and over again when we talk about artistically vibrant organizations. And so the social enterprise model is really sitting inside this idea of impact being the most important thing.
Absolutely, yeah. It's really, really essential to, it's called impact investing there. So with our organisation in particular, we treat ourselves like an investor. So when we choose to spend our personal time, our wages, our artists or our energy or our resources somewhere, like even being here today, it's a choice that we are making this as an investment because it's something that we believe in having a greater impact. So it's really kind of moving that mindset from being and I'm not saying this is a negative way, but if you're looking at for social enterprise revenue, it's about moving your mindset particularly from a hand to mouth, we need people to fund us to do good. You just need to fund us because, to really understanding a lot more around your value and treating yourself as an investor of the resources and assets and finance that you have into creating the most amount of impact. If you get that kind of mentality, things just start to line up and people see that because it's articulated through your culture, and they will tend to just find money for you. It's I can give you lots of different stories about all the really unusual things that have and opportunities that have arisen because that is clear in a conversation when we've had with somebody. Anyone just want questions on that? I know it's a very, very brief overview of if anyone's not familiar with social enterprise. Okay. Right, so I just wanted to quickly say, so all the examples I'm using today is just from Euphorium. So we're really open, pretty transparent with people if ask any questions. So I just want to use this as a base for the case study that that we work through. So we actually have a really diverse revenue stream. It's broken down. It's diverse in terms of the people that the type of stakeholders that revenue comes from, which is really important and we're going to cover. And it's also diverse in the type of revenue and the products we sell. Now, these can be detrimental and they can be a bonus. It's just about really understanding and having a clear idea of what that is for you and why you have made those conscious decisions and just being aware of it and then reaffirming it. I'll probably come back to this slide actually to reinforce something, but the major thing I wanted to the major point of interest in terms of our model that we have is 84% of our revenue was not from a funding source last financial year. So, and even the revenue that wasn't only $6,000 of that was from a funding application that we put in. That other funding was from contracts that we picked up or worked with an organisation that had funding for something. Most of the work we do is producing, is for the largest component of our work, and then we have out of where all the revenue came from, it was about 246 people paid us for different things. But the major thing is only 5 of those people who paid us in the last financial year made up $100,000 of that overall $180,000 revenue. And that's going to become really important. So 2% of the people we actually work for, whatever, get money from, actually made up majority of our revenue. And that's going to be something that's going to come up and that you need to understand about your organization as well. All right, so because I was talking about it from a sales point of view and a business development point of view, I'm going to be ratting out on accountants and financial people a bit today. That's just a lot of angst as a salesperson being told that I haven't filled out paperwork correctly for 10 years. So that's just me working through that problem. But basically, the question you really need to be asking when you look at your accounting system, accounting records, whatever it is, or reporting is, who are your financial systems and reports working for? Are they, are your financial accounts a record-keeping tool or a tool for planning, or are they both? And generally, and I'm making an assumption here, is most organizations we work with is they're very much a record-keeping tool. And these are a collection of quotes that I have actually heard said to me. And the most scary, but yet favorite one is, I can see how much money is in the bank account and they're looking good. So it's about just being aware of what is your accounting system, who is it servicing. So we're going to break that down. So generally there's two mindsets when we look at financial figures, and they're always kind of competing and at odds. However, you're probably just never aware of it, and you've just never thought about it before. If you've worked in a bigger organization where you've had departments, you probably definitely have experienced this, but in a small organization where we're all kind of nutting it, pitching in to help out, it's going to be less visible. So you'll generally face two competing mindsets. These mindsets will be a pull between the people who need financial information to be able to take action and do things, and the people who need financial information to audit, check compliancy, and acquit. So you can really clearly see here that in the art sector in particular, we face this push and pull really strongly from funders, board members, and your accountant doing the audit. And we also see the pull the other way, or maybe not the pull the other way, from the actual organization's managers, the coordinators, and the chair. The type of information that each of these two different people or organizations or groups need is really different and has a different perspective. So if one is dominating the conversation on the way that your finances are reported and structured, you're actually going to be limiting yourself and potentially not enabling yourself to be able to see what you need to see to be able to make effective decisions and see opportunities. So a couple examples here of where this might be. And so what I would normally do is get, fill out like a little survey. But I think it's good just to have a look and see where, if you had a little sliding scale in each of these arrows, where would you sit in the organization in terms of the accounting system or the accounting reporting? So who's servicing more? So what each of those needs. So the manager, those people who are actually active thing, it's all about information to make informed decisions on a regular basis. Whereas the accounting and the acquitting side is more about, they want to know the financial position and the compliancy. It's like a health check. They want all the numbers to come in and then they'll check it. But for a project officer that's about to do a show and doesn't know if doesn't know if it's profitable and how many extra tickets they need, that's no good to them. This type of thinking is obviously really good for internal managers. The other one's external. The manager side, so the purple side's very much the future oriented, always looking forward. What do we need to do? How much do we need? How do we make the gap? And we close the gap? The accounting very past orientated. So you can see some really common themes here. And I'm wondering if anyone, you probably are hopefully identifying with some of these. The biggest one is the actual rules that you apply to the way that you work your accounting system. Generally, your accountants or funders, the amount of times I've looked at chart of accounts in people's accounting systems and arts orgs, and they are set up literally in the same manner that the funding organisation has requested information. That's really good to be able to make it easy to report at the end, but it doesn't enable that organisation at all to be able to make daily decisions on the effectiveness of implementing that particular project or funding application. Whereas on the management side, you kind of want a system to be set up the way you need it set up to do your job more effectively. So it's a balance. Does anyone see that is an issue or is something that they can identify in their own organisation? Stunned silence.
Yeah, totally. Constant struggle, that one, just the amount of different lenses that you have to put the figures through to satisfy different stakeholders. It's certainly over this COVID time, we've kind of been pumping out probably budgets, like at one point, probably 5 times a week for different people with different lenses on.
Absolutely, and the point and the problem becomes is you end up the amount of organisations who have really good flash accounting systems, but then end up managing their budget in an Excel spreadsheet is too many. It's not working smart for you to be able to make decisions to deliver impactful work. And if as organisations we do exist to deliver value to the community, so it's about just being aware of where the system is being built to on a bias basically, and just making sure you're countering that, so it's not just fully all the way over one side if it's if it necessarily is. Yeah, and sorry.
Oh, I was just going to say, for us, I feel like I'm getting the system to the point where my system is actually quite complex and big, and then I can spit out pictures of that to different people depending on what it is they want to see, so it's kind of getting there. But yeah, I hear that.
Yeah, the more you can understand it and drill down and it's useful for you, actually I tend to find the easier it is to put into a format that's answerable to the external people. So yeah, I definitely would kind of, without seeing it, I would normally skew that way. So if you're finding that you're maybe particularly the person that's kind of pulling the way that things are structured one particular direction, there's some really easy things you can do. If you're a manager and you're constantly just making up account codes and it's just freedom to do whatever you want, and the accountant spends half the time trying to work out what's what. Basically, you want to teach yourself. You want to do less of making it the Wild West and actually look up some best practices. And so when you're just kind of freely making things to work for you, that you're at least adopting some standard operating procedures of some kind or taking from somewhere. Google is a great source. However, if you haven't got access to a lot of it, you really need to start teaching yourself what the numbers can actually do to empower you and focus there. So don't treat them as a daunting thing. Like, find a reason why, if you knew that, if you had better access to that, you could make more informed decision here, then that's a great place to start, because spending your time trying to work out how to solve that problem will become worth it very quickly. Same on the other side. It's more about doing less. If you're on the other side, it's just being less about nothing will be perfect, and spend time getting it. Don't spend too much time getting it right over the sake of making it usable. Every accounting system comes with very prescribed accounting codes. I really wish they didn't, because the numbers and everything allude to the fact that that's the ones you have to use. Of course, it's better that way, and it makes it better for accounting. But that's the great thing about submitting your accounts to the accountant. They can work out where to put things if you've really got an issue. So just pick the things that are, so the best of if you want to nudge it one way or the other, just pick the things that will be the most important to empower you, and just focus on that. Don't try and solve everything at once. Don't do a big cleanup day. Don't just pick one thing that if I can get out of the system or my reports or whatever to help me make better decisions or be more impactful here, just start there, focus there. And then you'll start to work your way through it, and a path will become clear on how to structure it. Any questions on that before I go on?
Julian, I just note that the frustration for me is the limitations on the system we're actually using, and particularly around some of the reporting. The reports that I would like to be able to access, I can't. And the only way I would be able to do it is to actually get a download of the transactions and build the reports myself externally, which is inefficient and time consuming, and even extracting the data is problematic.
Yeah, I have a lot more to say on that, and I won't today. But there's a lot of worthwhile accounting tools out there that are easy enough and worth the investment. If I don't know what you've got, but I think I'm happy to chat. I can flick you an email after this if you like, and yeah, I can definitely. I've got some advice on that if that's relevant. So, okay, everyone's okay if I just move on, because I think we're going to run out of time otherwise. All right, so we're going to move. So that's about accounting. That's about the mindset that you're looking at your financial figures, and just being aware that it's not always just about getting the accountant's audit right or the acquittal right. It's really about making it a tool. If it's a tool that's empowered for you, then you'll actually set it up and you will have it all up to date more often, and it'll be easier to quit things. All right, so we're going to switch now to revenue and talk about different types of revenue. When we're looking at revenue, generally you can group most of the revenue from your organization into two different buckets. These two different buckets are business to business revenue and business to customer revenue, so B2B or B2C. What this basically means is B2B revenue, so business to business revenue, is where you as a business, you're an organization or business, is basically getting money, or a business or an organization is paying you, a business, to then deliver something to individuals or an end user. Business to customer is generally individuals are paying you for something in particular. The easiest example of that is ticket buyers, members, shop sales to the public. Individual donations are all B2C. Funding, grants, sponsorship, service provider, but even a social club, like selling a package to a social club to come to your show, is a B2B. It's about a bigger chunk but you're dealing with one kind of group. So obviously those graphics there, I hope are clear enough. But by structuring, by understanding what the percentages of the revenue that you actually have, you can start to get an idea of where you might be having financial problems and causing yourself traps in your organization. So the example I will use for Euphorium, or when the first time we collapsed, is we were extreme when we did a lot of comedy shows, mostly before we moved into community development. We were extremely highly dependent on ticket sales, which is B2C revenue, and it was working really well for us for about 2 years. So we would have been about 80 to 90% B2C. That is fantastic until the market shifts, and because we were reliant so heavily on that one particular B2C revenue, the moment people were like, oh, I've kind of been to it a bit now, it's getting a bit old, or they kind of just weren't as interested and wanted to do something different, our entire revenue structure just collapsed, and we just couldn't make enough money to be able to then make ends meet. So you might have the other side where you're B2B, maybe you get all your money from one funder, and that could be 90% of your revenue comes from one funder, and that funder decides that they're not going to fund you next year, then you're also more vulnerable. So understanding this, and this is where we go back to the point at the start, it's just by getting an understanding of revenue as it sits currently, you can actually really start to see where your risks are, see where your opportunities are, and make plans. All these are in the document, so I might, in those documents that have been provided, so I might just kind of skim through some of these, but they're basically highlighting the risks and the benefits of each type. It's not a matter of like, okay, well, we're going to be only a B2C or we're going to be B2B. It's a matter of just going through the process to understand what type of revenue it is. Now, the major thing I want to say about B2C is, so B2C is generally going to be all your members. Is generally, I'm generalizing, all the people you engage with, people that buy tickets, people that buy drinks at the bar, people that buy art from the shop, whatever it is. So they're all going to be they're all individuals. So you're actually dealing with maybe 300 members. Whereas your B2B side, you're usually only dealing with, 5, 6 stakeholders at the most. So the level of cost involved in the delivery of dealing with 300 people individually versus 5 people for maybe the same amount of money really just needs to be explored and understood. So if you can understand it, you can then start to see the opportunities and the risks. Did you have something, Annette, you had about this that when we went through this the first time?
No, I think it's good for you just to keep going because I'm conscious of time too, and
no worries.
It's super valuable.
All right. So look, we're going to look at different types of revenue. So I've broken this down to very simple revenue components. You might have things that fall outside this, but this is just going for a very standardized version. So generally, you can break your revenue into 2 parts. You can have non-operating revenue and operating revenue. Your non-operating revenue is going to be side hustle revenue, all the things you kind of do on the side that make a little bit of money. If you've got a building, it could be renting it, could be interest on the bank account, or if you've got any ownership in something, it could be just dividend returns. Stimulus at the moment, JobKeeper is also non-operating revenue. Operating revenue is generally, we can break it down to 4 different areas, 4 different types. We have transaction-based revenue, which is revenue that's it's someone paying for something once, and they don't necessarily come back and pay again. So a ticket or an art, they buy one art, cake stall even, or a sausage sizzle, whatever it is. Service-based revenue is providing a service stakeholder over time. So generally, if you've got people who are delivering services for someone that'll by the hour, that will be service revenue. Project revenue is projects that have large funders and highly customized. So here is X amount of money to deliver these outcomes. It's a big lump sum, or it's a chunk of money to achieve this particular goal, and you work out how to get there. It's not a pre-subscribed product. And then reoccurring revenue, which is memberships and subscriptions and things that just roll over from month or year or term to term. So there's a couple of, just with these really basically, if you're looking about, the reason we want to break them up is they actually need to be approached differently. The risk with service and transaction is they fluctuate demand. If a pandemic happens, your transactional revenue could be completely wiped out. The way that we actually can then, when we're planning this kind of revenue, is we want to focus on our historical data. We want to look at the trends. So we know that every year we sell more and more tickets. So we can assume that next year we might be able to increase it by the same amount. So it's really easy if you've got some historical data to do the plans. With project revenue, the biggest risk is volatile and stakeholder dependent. So you will generally have like a funder, here is X amount of money to deliver these outcomes, but that funder could not be there next year. So you lose a big chunk. It's also very stakeholder dependent in the sense that you really have to spend a lot of time investment working with that one stakeholder and really dedicate your time. But there is opportunity there as well. If you can focus on the multiple of things that you can do for that one person, you can then also expand the amount of revenue you might bring in from that. And then reoccurring is really great. It's great for organizations because it is fantastic cash flow. But it's very slow to start. So getting a members drive, bringing on young people for a youth program, it's slow to start, involves lots of investment. But once you get it up and running, you can then rely on it generally ticking over. All right, we going okay?
Yep, doing good.
Okay, cool.
I'm just like, Willarara is such a different beast, being in a like really remote community and work, and in a community where like it's so there's so much poverty, I guess, and that type of thing. So we, like there's the sort of types of revenue that we can get are not ticket sales and not, like even sales and all the other kind of like outward facing stuff in terms of engaging a broader public takes so much, investment from, at the moment, just myself, who's the only person,
Absolutely. And so because of your circumstances, you've already been forced to think about this and understand the type of money that you can attract. So you've already kind of gone through this process without really knowing the different, maybe categorizing different areas. Because of your circumstances, project revenue is basically your only viable source. So, but once you can understand that, as you have, you then know, okay, well, this is the strategy. I need to build strategies and investment of my time or things in the organization to focus on how do we solidify that? How do we increase that or make it stretch further or whatever it is? So yeah, so you've already gone through that process to identify it. And once you identified it, you now know you can put all your brain power into thinking about how to actually expand on that. Is that fair?
Yeah. And I guess also, like, I guess we do a bit of service to other organizations, and, like, I try and get other people to pay for us to do things in the community. So
great. No, perfect. So that service revenue is brilliant. And so once you know that's there, you can start to expand it. Understanding it as a different type of revenue just gives you that kind of headspace to be like, okay, that's that type of thing that we can do more of. We've done it here a few times. I can see where I've done that a few times. I wonder if we could do it a few more times with a few different people we haven't spoken to yet. So just by breaking it down, you can see what you've done in the past. You can then identify how can we duplicate this more, or how can we, what are the opportunities here?
Yeah, thanks.
No worries. All right, thank you. That was a really great example. So I'm going to keep moving. Yep. All right. Just before I move to the next slide. So what we're going to do now is we're going to quickly look at how this might apply in a sense of your chart of accounts or your profit and loss statement. So looking at those different types of revenue, the most common thing I see when I look at a organization's chart of accounts or revenue account codes is they will have things like Lottery West funding 2020 as a revenue code, or such and such project, where that's more the project, and what we need to think about is how is the revenue actually entering our organization. So we're going to just quickly go through a rough breakdown, the building blocks of a P&L, and then I want to look at applying those different revenue structures to that and how we would go about doing it. Great. So for those who have never seen or don't fully know, I'm just going to be really simple here for a minute. So a P&L at an organizational level needs to look a little bit in this manner, where you have these different building blocks that would work down the page to make up your profit and loss. If this is blowing over your head completely, just email me after this and I can go through it with you. But you've got your revenue, as we just talked about. You've got your other income, which is your non-operating revenue. You may have your costs of goods, so the costs of actually delivering your programs or products separated out from your operational expenses, or you may not. Generally, it's a good idea to have it separated out, but it's not a hard and fast rule. And then you have your obligations, which are more your GST and debt obligations. But these will give you, by working through them, these will give you your P&L. It's very simply broken down. You add it, you add the revenue, take away the direct costs, equals gives you gross profit. You take away the operational expenses, gives you operating income. Take away the cost of debt, take away the obligations, you get your net income. So that, I just wanted to make it a really boiled down version so that when we're referring back to it, there's something here you can refer back to. If yours doesn't look like that, then you can kind of work out why. The really important thing I find that maybe isn't done as much, and I'm not suggesting you go out and do this straight away because you're going to cause yourself a big headache, but if you ever get the chance to work on your chart of accounts or on your P&L, a lot of organizations don't have their costs of goods separated from their operating revenue. So they can't actually fairly say if X project made or lost money. That's really important, because if we really love the outcomes of our community outreach program A, and we want to do more of that, and we then start, we times the output by 10, we add 10 workshops instead of 1 next year. If we don't know if that is making or losing money, we've just times that, whatever that make or lose money is, by 10. And if that was lost $500 per workshop, it might be manageable and hidden in your P&L this year. But if you times it by 10, it could be, end up being at a loss of $10,000 that could really cripple your organization without realizing it. You get around this by doing little project budgets in Excel and whatnot. However, it's a really good idea to think about are your operational costs and your costs of goods separated? Because you will be able to make much more powerful decisions knowing that on how sustainable a project or product is. I've got more chart of account stuff that breaks things down for expenses, but I wasn't going to go too much into that today, but I'm happy to share that.
I think Andrew has a question,
well.
Julian.
Yeah, sorry, go Andrew, yeah.
Just a comment. If anyone is actually using MyOb as their accounting system, there is another option besides just your chart of accounts, and that is the job section. So every transaction that is linked to that can be classified as a job as well as your chart of accounts. Just an observation there for you.
Yeah, so you want to use your chart of accounts to track your revenue and expenses types, and then you want to use your job or tracking codes. I think they're called in Xero, and they're called locations in QuickBooks as your way of breaking down projects. Once again, like that's a system side of things. I'm happy to talk about that at another time because I think that's really, really valuable and worth doing as well. But yeah, save your chart of accounts or save your P&L for the type of revenue and use tracking codes to break it up into projects.
So Julian, can I ask you a quick question?
Go, please. Yeah.
You're suggesting that the direct project costs, so artist fees and that kind of thing, sit up in that cost of goods sold section, and that your operational, so your administration costs and your kind of general, admin stuff and stuff sits down in your operational. Is that what you're suggesting?
Yes, but essentially yes. I think it's a really good way. There's two ways of doing it. I was going to put it in today, but I decided against it because you can break it down so many different ways. But you can basically separate it into variable and fixed costs, or you can separate it into operating and non-operating costs.
I think that's a really big change because we tend to just group like all of our wages and fees all together. When we look at our overall P&L, our consolidated one. So that's a very interesting.
Absolutely, it's very powerful to know if a project is sustainable, so that you can grow that project in the next year, or if it is a loss, you can continue to invest in that project, but manage the risk. So okay, we lose $1,000 if we do that project. That's okay. It's totally fine, but we can only afford to lose $4,000. So that means we can only do four of those. How do we get more money to fill that bucket? Yeah. That's making sense why we'd want to know that information?
Yep.
Yeah. Okay, great. So if you don't know a chart of accounts, it's okay. It's basically a chart of accounts is just your index of all your account codes, all the different things that you put account codes under. One day I want to do a session where we all share our terrible account codes that we've created in our lifetime, because there's freaking brilliant ones I've created in the past that are just so ridiculously stupid. So look, if you're looking at your P&L now, so have a look at your P&L, and is your P&L, we're just looking at the revenue section, is it broken down into really clearly illustrating the types of revenue, or is it broken down to illustrate the projects or the fund that they've come from? And that's okay as long as there's not like a mix of revenue. The example I would give is, say if there was a festival, if you did a festival and you had an income code for such festival name income, and you had bar sales, ticket sales, and sponsorship and grant money all under that one code, you wouldn't be able to really clearly see what makes up that festival income and how you can actually expand or develop or grow certain areas, or what's even what areas are even profitable or not profitable. So use the revenue types as a way to guide yourself into reorganizing it if you're going to reorganize it. I highly recommend you reorganize it. I highly recommend you reorganize the chart of accounts, especially since it's the start of financial year. If they're not somewhat reflecting this organized in the same way. So these are just some examples. The great thing about your chart of accounts with revenue and expenses is it's really up to you. The balance sheet side of things, that's more like compliance codes, so you need to have those in the correct places. But in terms of just revenue and expenses, you can really kind of, it's not a free pass, but you can really structure them how they're going to work for you. So grant income could be one revenue code under project. You can group them into groups, or you can just have more than one list, but just as long as you're not grouping several types of revenue in one. If you do this, and this is why this is really important, if you do this, I promise you in 12 months time, when you come to do your budgets again, you will thank me, because it will be so much easier to financially plan because you can clearly see the types of revenue. And each of these different brackets, as we talked about before, have different planning mechanisms that you just apply to them. So if they're clearly broken out, it makes the planning really easy. Once you have the planning, you can then set goals for them. Once you have the goals, you can then report against them and see if you're actually on track to meet your goals. This is the most important thing I'm going to talk about today. Has anyone got anything to add, or just question to comment even?
I think I love you, Julian.
Good.
I think that just, I just looked at my P&L and it's frightening. It has three categories, like 3 useless things on it under revenue. And yeah, this is.
And that's fine if you kind of know, and this is the problem, is we kind of know what goes in our organization, so we don't tend to, it's not really a problem. But when you really need to plan, it's not clearly there, and it's not clearly there what action you're doing. I actually have to thank Shannon for this, because 2 years ago I went and spoke to her and I said I wanted to write up this chart of accounts problem when I was in Canny, and I just never got around to it. So now, because of this workshop, I've finally been able to write it up. So it's partly Shannon's fault. Breakouts. The second thing is, if you've got your revenue codes, you will also generally, there's an area called other income codes on your P&L. If it's not there, it's just, you can see in your chart of accounts. Try and move your non-operating income there if possible, particularly JobKeeper. So if you've got JobKeeper or stimulus payments, please move it there, because that is going to throw your organizational figures out if you ever try and report historically for the next couple of years. If you have it just under another code, revenue in or grant money or something, someone else will pick up the books, a new treasurer, and they'll be like, oh, we just can't seem to make the money we used to. So just make it really clear that it's a very unique set of circumstances. Okay, so just on expenses, this is what I was basically going to comment. The comment I had before is you can break them up into fixed and variable, or operating and non-operating, and still they're not even golden principles. You can flex them however you want. The biggest issue you're going to have, and the biggest asterisks you're going to have if you want to really break up your expenses that way, is wages. Wages get really problematic, because sometimes wages are spent working on a project, sometimes they're spent working operational. For us, it was really important to solve it. So we have now, we all have a time tracking app that we track every single hour against a project, and the system then sorts it out. However, a timesheet might do the job, and it's just a manual journaling. If that's what's important to you, just work out what do you need to know, what you critically need to know, and then make sure your system can easily report that. If it's going to be too complex, then find something else to solve for the moment. Now we're at financial year, it's a perfect time to have a look through that. That is like a really brief overview of the stuff I want to talk about with charts of accounts, because I think this chart of accounts situation, I think, would save art centres. I really believe if as a sector we got fixed this, we would have massive benefit. Yeah, anyone else, any questions on that before I move on? Okay, some of you I know will be, I'm telling you to suck eggs here as well, because it can be. And the other one is as well is I'll listen to this stuff sometimes, and then I'll put this to workshop together, and I looked at my account codes and I was like, oh, whoops. And then my revenue codes were screwed up. I put them the wrong way around and whatnot. So it sometimes is, even if you are sitting there going, well, I kind of already understand, I've already got that sorted. It's a great way to go back and just double check that you've got it on the right track.
Julian, we've got 10 minutes left.
Yeah, great. I'm just moving on to the last bit now. So I'm just going to share. Can everyone see the spreadsheet? No?
No.
Oh, sorry. I'm just going to stop sharing and I'll share it again just to move page, sorry. All right. So in the document I have in the attachments, you will find a spreadsheet. In the spreadsheet I've taken a revenue planning spreadsheet that that I've been using for a couple of years, and just kind of broken it down to some really simple stuff that's relevant to this workshop. So this is where the asterisk is. I've gone through and tested a lot of the fields, but when I tend to give stuff like this out for the first time, generally like a formula is broken. So I apologize if there's a formula broken. If I find one, if someone finds one, I'll fix it and send out a revised version. But through this workshop, basically, if you've got your P&L, you can work through it. And I really suggest that you take the time, since we've run out of time today, to sit and just go through this and find the time. So what each sheet has a bit of instructions on how you can fill it out. And it just is going through the process of doing exactly what we talked about before, looking at your P&L, your historical data from the last financial year, and how does it fit into, and first of all, can we fit it into these revenue types? And if we can, let's put that in. So I've basically broken it down here with some examples. You'll see you don't have to follow these, they're just examples. You can leave them blank. And then in the yellow boxes, you basically fill in the revenue from the last financial year. It should then pre-populate all the other figures for you in the planner there to give you a bit of an idea, so you can visually see what is your revenue doing and where is your revenue coming from. So that's really simple there. So I'll let you fill that out. Over the page, so hopefully your chart of accounts is clean enough. If you can't quite fill this out, it probably means your chart of accounts needs a bit of work. So if you do that, you will, if you fill it out and it's not working, that's a great place to start. On the next page here, this is just a really simple B2C, B2B calculator. If you know what your ticket sales are, fundraising, donation, art sales, raffle tickets, and then any other kind of individual sales that you sell to an individual, drop them in here. And if you drop them in here, it will take your revenue from the first slide and just give you a bit of a breakdown of what that looks like. And so this is just, once again, dissecting your information that you have so you can see and get more intelligence around what's going on, and so you can see the risks and opportunities. So that will hopefully help. In the next couple of slides, these are optional. These are just tools for you to use. What I've done is I've taken the different principles for the different types of revenue, and I have applied them, put them basically into this spreadsheet so that you can try and plan and try and project. So I know, particularly with RASI, you need to provide these budget projections. This is how you actually go about doing that. So for example, I'm going to quickly walk through one here. For ticket sales, we might say, it's not coming over from the page before, but I might say we did $1,000 in ticket sales last year. If you just fill in the yellow boxes, it's all got these little help sections here which will tell you how to do them. So we know, if we know the rough cost, I'm going to say it was about $500 for those $1,000 worth of ticket sales we sold. If you don't know the answer to these questions, that's okay. Leave them blank. It's a great opportunity to write that down as something that you don't know that maybe in the future you want to try and build into your system to know. The question here, is it sustainable? Is your project or is the ticket sales currently sustainable? It's a really important question. If you can't answer this, that's something you need to work out, because if you continue to kind of increase that or do more of that activity, not knowing if it's sustainable or not, and it's that question again, it's okay to lose money, but just know how much you're going to lose so that you can plan. If you can't answer this question, then that's a great place to start in looking at. We always want to break things down to make them easy to plan into units. So what I've asked here is just like, what type of unit is it? Is it a sausage sizzle? Is it a ticket? Is it whatever that transactional, this is transaction and service-based revenue. Whatever the unit is as an individual, how many of those you sold. So let's say we sold 1,000 tickets last year. And then in here, you can put in here, what's your goal to sell next year? So we had 4 shows. Next year, we think we can increase that. We're going to put it 1,300. And then it'll just calculate here a little estimate of what your projected revenue could be for the next year based on your historical information you've put in there. So with transactional and service, it's always about using historical data to basically plan what could you do differently and then it uses the past history to then apply. And then the last one here is just, what's an action I can take? What action do I need to take? Well, to be able to get that extra ticket sales that I've decided, we're going to need to do one more show. Now we know we've got a budget for 5 shows instead of 4. So when it comes to putting your budget together, it's less of just putting numbers in and plugging them in, and more of doing the thought work around, okay, what does more ticket sales revenue actually mean for us? What does more shop sales revenue actually mean for us? Service and transaction basically work the same. Reoccurring also works the same, except it basically asks you like the number of individuals, the unit of time, and then how much it repeats itself in a year. So you can just plug those numbers in. All these little green boxes will explain to you little hints of how to do it. The last one is project revenue, which gets really tricky. But this is when we come to forecasting and budget planning. Project revenue is really important to list all the opportunities and leads or grants that you could apply for, or that you're wanting to apply for, or service contracts you're wanting to get. If you basically, I've got in here the Razzie grant, you fill this out, where the others are, you just list them in there. It could be a service contract with the local government, could be a grant. And what we want to know is just, what is that project going to be worth? So if we're applying for that round, and then if we know the costs of actually delivering that project, sometimes we don't, sometimes you can just make it up. As I said, this is all about estimating and just planning. So just fill it in, have a guess. Is it sustainable? Same question again. Then we get to the last part, which is about how we actually plan project revenue. And it's using what's called a conversion rate. Now, I'm sure most of you will know, if I was to ask you how as a percentage, how good you were at winning grants, that percentage that you give me would basically be your conversion rate. How good are you at actually winning a grant, or how likely is it that you will get a particular project? So what we want to do is we want to put that conversion rate in there, that percentage chance, the odds of actually getting that, of what we feel. It's very much from a gut and experience level, but it will then basically factor all the factors you put in there and the value of that grant or service opportunity, and give you what's called a pipeline value, which is an expected estimated income. Now, if you're doing it for one project, it doesn't really work, but if you've got a series of project revenues, different grants, different projects you want to get, and they've got different percentages, you'll then get a collection of these kind of projected pipeline values. More often than not, and it's crazy how often it happens, that pipeline value actually tends to be a pretty spot on number for the total you actually will win, or the total you actually will get by the end of the financial year. It may not be exactly as you planned, but that number actually comes out pretty clear. So in terms of planning, like how many people, wages we're going to need, how many, are we going to need a space? Are we going to need all these different things? Especially if project revenue is a big part of it, putting that in there and putting that conversion rate in will give you at least an indication of what it is that you could achieve and you could bring in. Okay, so hopefully those planning tools work. So with asterisks I went through there. But even if they don't, the principles are the sound. So when you're looking at those, this is why it's so important to break those types of revenue down, because the principles we use to actually plan and project and budget are different. We can't apply the same to all of them because they're different types of revenue. Does that concept sit with anyone? Is that speaking to anyone that can register that, or that's something that they're going, okay, cool, actually I could consider that?
Yep.
Yeah. Okay.
Yeah. I think for me, it's really busted apart how I think about income, and also I like the pipeline estimate, because then it's not. Sometimes we get caught in this trap of, well, I didn't get that project grant, therefore I can't do that activity. But if you take that more global perspective of everything has different chances, and overall your organization continues to operate and achieve the goals regardless of the individual project grant outcomes.
Yeah, exactly. And then you start to get an idea of the pipeline value you need. Like, we need about $100,000 in the pipeline roughly, so that by next year you're kind of keeping an ear out, you're looking for grants, looking for opportunities. Yeah, I call that. It's about, now we got to 100. All right, we got to apply for these things. So it's just a good also forethought. I'm not using my words well today. Forethought kind of process. All right, so I'm going to finish there because we've run out of time. There is one more slide there is one more section in there around breaking down B2B revenue. I'll let you explore it at your leisure. It's got the instructions on it, but this will basically break down. Once you have your account structures and your planning tools in place, this next B2B planning tool is the most important thing that you can do to understand what the opportunities are. So just follow the instructions, but basically what it'll bring out is on this first slide, which I just want to end on, Annette, sorry. We're trying to cram a lot into one session here, sorry. No, it's not. It's not going to show me, but essentially what it'll do is it'll break down your percentage of your stakeholders that you actually work with and the percentage of the revenue that comes in. And generally, you will find that about 10 to 1% of your stakeholders will bring in about, 20% of your stakeholders will bring in 80% of your revenue. If you've ever heard the 80-20 rule, 20% of your stakeholders will bring in 80% of your revenue for your organization. And if it doesn't look like that, then you're missing opportunities. If it's the other end where you have 90% of the stakeholders are bringing in lots of revenue, it means that you're missing opportunities as well. So that's just your next step and where you might want to go. And yeah, I'm happy to always ask questions, answer questions about that.
Thank you, everyone. Thanks so much, Julian.
No, thank you for letting me come and talk about this.
Yeah, thank you.
Thanks, everyone. I've got a dash, and of course, I'm running late now.
Thanks for your time.
It's the story of my life. Bye, everybody.
See you later, everyone. Have a great day.
Thank you.